Meta's new AI push is scaring investors, and the reason has very little to do with whether artificial intelligence will be important in the future. Investors already agree on that. The fear comes from how Meta is choosing to pursue AI, how much it is willing to spend, and how familiar this story feels to anyone who watched the metaverse strategy unfold. At a surface level, Meta's AI push looks logical. The company sits on massive amounts of data, owns some of the world's largest social platforms, and has the technical talent to compete at the highest level. AI should be a natural extension of its business. Yet instead of reassuring markets, Meta's recent moves have triggered concern. The stock reaction, analyst commentary, and investor questions all point to the same underlying issue: confidence in execution, not belief in AI itself. The first source of fear is capital intensity. Meta is committing enormous sums to AI infrastructure. Data centers, custom chips, compute capacity, and long-term power contracts are being scaled aggressively. These are not flexible investments. Once made, they lock the company into a cost structure that assumes sustained AI demand and monetization. Investors remember that Meta made similarly massive long-duration bets on the metaverse, only to later scale them back after years of losses. What makes this uncomfortable is timing. Meta's core advertising business has stabilized, but it is not in a hypergrowth phase. Margins matter again. Every dollar allocated to AI infrastructure is a dollar not returned to shareholders or invested in safer optimizations. Investors worry that Meta is once again prioritizing ambition over financial discipline, especially when returns from AI remain uncertain. The second concern is clarity. Meta talks about AI everywhere, but it has not yet articulated a clean, simple story about how AI will translate into durable revenue growth. Improving ad targeting helps, but that is incremental. Generative AI features increase engagement, but engagement alone does not guarantee monetization. Investors want to know where the step change comes from. So far, the answers sound broad and long-term, which markets typically discount. This uncertainty is magnified by Meta's history. The company has a pattern of bold strategic pivots driven heavily by founder conviction. Sometimes that works brilliantly. Other times, it leads to years of heavy spending with limited payoff. Investors are not questioning Mark Zuckerberg's belief in AI. They are questioning whether belief is once again overriding market feedback. Another factor unsettling investors is competitive pressure. Meta is not leading the AI race uncontested. It is competing with companies that either monetize AI directly through cloud services or control enterprise distribution. Meta's platforms are consumer-focused. That makes monetization harder. AI features risk becoming expected, not premium. If every social platform offers similar AI tools, pricing power disappears. This raises a critical question investors are asking quietly. Is Meta building AI to defend its existing business? Or is it trying to invent an entirely new one? Defensive investments protect revenue but rarely justify massive valuation expansion. Transformational investments require patience and belief. Right now, Meta's AI narrative sits awkwardly between the two. There is also concern about margin compression. AI workloads are expensive to run, especially at Meta's scale. Even if AI improves user experience, it may raise operating costs faster than it raises revenue in the short to medium term. Investors worry that Meta could end up with higher engagement, higher costs, and only modest incremental monetization. That is not a profile public markets reward. Regulatory risk adds another layer of anxiety. AI increases scrutiny around data usage, content moderation, and algorithmic influence. Meta already operates under intense regulatory pressure globally. Expanding AI capabilities amplifies that exposure. Investors fear that Meta may be investing heavily in systems that later face restrictions, fines, or forced redesigns. There is also fatigue. Markets have a memory. The metaverse push-conditioned investors to be skeptical of grand visions that require years of spending before payoff. Even though AI is far more practical than virtual worlds, the spending behavior looks similar. Large budgets, long timelines, limited near-term visibility. That similarity alone is enough to trigger caution. Importantly, this does not mean investors think Meta is wrong about AI. Most believe AI will be central to Meta's future. The fears about balance. Investors want Meta to pursue AI without losing financial discipline, without repeating the mistake of overcommitting before demand and monetization are proven. Some investors also worry about internal focus. Meta is trying to advance AI while managing core platforms, regulatory battles, and competition from newer social apps. AI demands deep organizational attention. Splitting focus increases execution risk. Markets tend to punish complexity when outcomes are uncertain. Another subtle issue is narrative control. When Meta frames AI as existential, it signals urgency, but it also signals risk. If AI is framed as necessary to survive, investors infer that current advantages may not be durable. That creates discomfort. Investors prefer AI framed as an amplifier of strength, not a defensive necessity. So why is Meta's new AI push scaring investors? Because it combines massive spending, uncertain monetization, competitive pressure, regulatory exposure, and a history of bold bets that tested patience. It reminds markets that Meta is willing to sacrifice near-term certainty for long-term positioning, and not all investors are comfortable with that trade-off. The irony is that doing nothing would likely scare investors even more. Meta cannot sit out AI. The company is trapped between two fears: invest heavily and risk overreach, or invest cautiously and risk irrelevance. Right now, markets are reacting to the first fear. In the long run, Meta's AI strategy may prove essential and profitable, but public markets live in the present. They demand clarity, discipline, and visible paths to return. Until Meta proves that its AI investments can generate meaningful, scalable revenue without crushing margins, investor anxiety will remain. This is not about whether AI is the future. It is about whether Meta can pursue that future without repeating the mistakes of the past. And until that question is answered, fear will continue to outweigh excitement.